Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Caution grips Asian markets after Jay Powell maintains a wait-and-see stance on rate cuts amid trade war uncertainty, dashing hopes of a Fed put. Chips back in focus as we await TSMC's first quarter earnings, with the sector under pressure from NVIDIA's latest China sales curbs and a muted outlook from ASML. We are seeing positive signs on tariffs, though, with Beijing suggesting it's open to talks if Trump shows some respect, while the president touts big progress with Japan. And we'll discuss investment strategies around these latest developments with two of the best in the business. Morgan Stanley's Andrew Slimmon is with us, along with Aberdeen's Pruksa, Iamthongthong. Well, here's where we're at with the trade war. President Trump is touting big progress as the U.S. and Japan begin formal tariff talks without discussing currencies. Bloomberg sources also say Washington's trade negotiations with dozens of nations will include a request to curb trade with China. On the other hand, Beijing has signaled that it's open to discussions with the U.S., even as President Xi Jinping urges Southeast Asian countries to jointly oppose what he describes as hegemony. Well, for more, Bloomberg senior editor Derek Wallbank joins us here in the Lion City. Our China correspondent Min Min Lo is also with us in Hong Kong. And Derek, let's start with you. What is DC looking at? I mean, it does seem like it's a case of getting its friends to gang up against China.
Well, it's not entirely sure exactly what D.C. is looking for. And I think, honestly, Haslinda, that's part of the issue here, right? Is I think a lot of U.S. trading partners are trying to figure out exactly what Trump wants. We've seen Israel go to the White House. We saw Japan today. We'll see Giorgia Meloni from Italy tomorrow. So there's some of the folks that Trump is closest with on the world stage trying to figure this out. Now, in the Japan talks, they didn't deal with currencies. We're not quite sure what they talked about yet on security, although Trump had signaled that that was going to be part of the discussions. But they are talking a lot about the economic trade balance, what U.S. products are allowed in, what U.S. products are being sold, and where the levels are. Remember, Trump had been talking about reciprocal tariffs, but those were actually calculated based on trade balance and trade deficits. So I think that's a critical point to watch. In terms of blocking in China, it certainly is something the administration has signaled they want to do. They don't want China to have an escape hatch. But that looks likely now that that's going to be kind of one-on-one in these individuals rather than something bigger and broader that might be sort of like a multilateral deal. We all remember the Trans-Pacific Partnership falling apart just as Trump was coming in 2016. There's no real move to kind of escalate or revive something like that.
We also know that trading partners don't really want to choose between the U.S. and China. And Min, what has been China's response so far?
Well, we can see that President Xi has been embarking on this trip in Southeast Asia, this charm offensive, visiting Malaysia, Vietnam, and Cambodia. And just, I think today or yesterday, we have President Xi penning a commentary on the Cambodian newspaper, something that is clearly targeted at the Cambodian audience, calling for jointly opposing American hegemony. And this is a similar message that we heard from President Xi after he visited Vietnam, calling on Vietnam to also push back against these unilateral tariffs against the U.S. And I think the concern here is, as Derek Wallbank had said, that the U.S. is trying to get other countries to gang up against China as part of its individual tariff negotiations with these countries, to get these smaller countries to curb their trade with China as well. So I think China at this point is trying to get these small countries to deepen ties with China. We've seen so many deals being signed in Malaysia, in Vietnam, and it's sort of getting these countries to also push back against the U.S. And these are smaller countries that on their own wouldn't necessarily feel that they have enough power and might to retaliate against the U.S. So clearly on this charm offensive to try to push back against any potential collective encircling of China.
So both sides looking for coordinated opposition against the other. Derek, we talk about those trade talks between the U.S. and Japan. Where are we with that? What are the details? Because we're short on details.
We are short on details, but we have a lot of sentiment. So, you know,
talk is cheap, they say.
Well, you know, it is, but it's also expensive in some ways, right? And the expensive talk can happen in 145 characters or less. In this case, Trump is saying in social media, big progress. What does that mean in practice? Who knows? We'll have more talks later. There's some thought that there's going to be talks in the coming weeks, another round of them. So that's a positive sign. You want to see that. But we did see Trump say big progress. We heard Caroline Leavitt, the White House press secretary, describe these as productive. So those are the sort of smoke signals you want to see coming out of the White House after that, even if we don't really have a bead on what the actual details of this might be. I do think that's a big thing. And look, as Minmin said, both of these economies, the U.S. and China, are looking to kind of play in a bilateral kind of way. In some ways, the U.S. is taking some lessons from China, which has for years said that they want to have one-on-one dealings with countries. And so you are seeing each other kind of play fairly carefully here. One of the issues that certainly will be in play is that if the U.S. does have 145% baseline tariff rates, they will want Chinese products to not flow to major consumer economies that are proximate. Certainly any list like that would have to include Japan just across the water.
And Min, of course, China escalating that tension with the U.S. itself. There's been a lot of focus on rare earths with recent actions from both the U.S. and China. Beijing now adding 7 rare earths to its export control list. I mean, this is crucial. We're talking about, you know, rare earths that are important to the U.S. from everything from smartphones to its jet planes.
Yeah, so the Chinese reasoning for these controls is that these rare earths have dual uses, civilian users and military users. And as you said, they are used in everything from nuclear rod reactors to the engines and motors that are used in wind turbines, also in smartphones, even in medical imaging as well. So a lot of day-to-day applications, very wide-ranging one. And interestingly, at the same time, the Trump administration also announced that it's opening up a probe into rare earths that could potentially lay the groundwork for even more tariffs on rare earth imports into the U.S. It could potentially lead to a divergence of trade flows, maybe away from China towards other countries like Australia, for example. But again, as China uses rare earths to gain leverage for these trade talks, we also heard from sources saying that China wants to see some willingness from the U.S. that Trump is willing to address China's core concerns when it comes to both Taiwan as well as the perception that a lot of the U.S. policy so far has been targeted at suppressing China's rise. And so both sides appear to be at very different starting points to even come to the negotiating table to negotiate for this trade deal.
And some saying now that it'll be a long time before both get together. China correspondent Minmin Lo, Bloomberg senior editor Derek Wallbank, thank you so much for joining us today. Now, aside from the latest moves on the trade front, investors are also weighing fresh comments from Fed Chair Jerome Powell. He snuffed out hopes for an early rate cut, saying the Fed's focus is to prevent tariff-driven price hikes from triggering persistent inflation.
For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks.
No Fed put, never mind. Asia still in the green, but barely eking out some gains, so about 0.5% right now. S&P futures also in the positive after that decline we saw overnight. We're tracking the USD, of course, in positive territory. Currently, the index, the gauge, is up by 0.1%. Of course, the dollar has been under a lot of pressure. China, though, in negative territory, down 0.1% as those trade tensions continue to extend. Well, our next guest is lead senior Senior Portfolio Manager on all long equity strategies at Morgan Stanley Investment Management. Joining us from Chicago is Andrew Slimmon. Andrew, when you're tracking headlines every single day and they're changing every single day, how do you even position? How do you invest?
It's exhausting. That's the problem. I think you can get too wound up in the news of the day. And as I like to say, unless you have access to the Oval Office at the White House on a regular basis, you're really making guesswork. I didn't hear anyone on Monday or Tuesday of last week tell me that Trump would put a 90-day pause on tariffs and that would cause a 9% rally. But if you turn bearish on Monday and Tuesday, you look kind of foolish on Wednesday. So I think the best thing to do is not to make knee-jerk reactions thinking you know what the outcome is, because I think it's a lot of guesswork at this juncture. Now, having said that, we know that when there are big declines like we've seen, that does create better opportunities for investing than when there's more uncertainty. And that's the irony here, Haslinda, which is the higher the business uncertainty level goes, the better the returns looking out 6 to 12 months, because the stock market is a forward predictor and it's already priced in that level of uncertainty. So on the margin, if you go from high levels of uncertainty slightly less, that is better than when you go from high levels of certainty to slightly less levels of certainty.
You're saying better returns in the longer term, but in what exactly? Because if you take a look at the trade war right now, all U.S. assets have been hurt. Sure.
So the market, as of Tuesday the 8th, was down about 18%. And if you look at the 1 year, if you just go back and look at every time the S&P's been down by that level, your 1 year return is substantially better than, your average 1 year return in the S&P. It doesn't mean it can't get worse than that, but just on average, once you get down 15, 20%, your likelihood of making good money just incrementally goes up, which all that really points to is buy low, don't buy too high. But perversely, that's not what investors do. They panic when prices drop, and that's just human behavior. I don't know any market in the world when prices go down, people are more willing to sell than buy, other than the stock market, but that's the reality.
So Andrew, buy the dip? Because Citi says do not buy the dip.
Well, I think at the end of the day, we learned something very important last week from President Trump, which is 15, 20% declines are growth scares. But once the market passes 20%, almost every time, that has meant a recession. And what happened last Wednesday is the market got awfully close to that minus 20%. And when that happens, the credit markets start to go, gosh, recession's coming, and it gets nervous. And the bond market starts to reflect that. Financial stocks start to sell off. And when Trump put the 90-day pause on, what he said was, I saw Jamie Dimon, CEO of JP Morgan, say, good chance of a recession. I didn't like to see that. I saw the credit markets start to seize up. I didn't like to see that. So I think what he basically said is, look, I'm all for these tariffs, but I don't want a recession. And so I think there is some type of Trump put out there that says, yes, I'm going to be tough, but if I see the economy go, into a recession, which usually happens when the S&P is down over 20%, I think he's going to reverse. So it doesn't surprise me that the Fed said they're on pause, because the Fed is backward looking in their data. Inflation's been okay. Look at the retail sales numbers. It was good today. These are all backward looking indicators. The question is, if the economy weakens, which is forward looking, will they have to pivot?
You know, it is quite surprising that some people have said that Trump's pain threshold is actually lower than most people thought. We saw that reversal, that 90-day pause. You know, it's been quite surprising as well that the dollar and the bond market have pretty much moved in tandem. Why is that, you think?
Well, I think what's a couple things. Number one is, like I said, as you get down to the levels we got, it usually projects a recession. That's bad for credit spreads, the credit default spreads, and so forth. And then I think rates are a little higher because there has been dollar weakness. Clearly, there's some repatriation out of dollars, and the gold market is telling you that. So I think it doesn't surprise me that bonds are sold off a little bit with the weakness of the dollar. I think that's coordinated, and clearly some of that money is coming out of the dollar into gold.
Right, so it has implications on allocations. What are you seeing, and how are you positioning for the next 12 months?
Sure. So I'm a long equity manager, so it's just a matter of, I'm invested, but do I want to adjust my positioning? And time out, the biggest mistake I see people make in this business is after a decline like we've seen, they buy more defensive stocks. It is the worst thing you can do because you want to buy defensive stocks when they're at highs, when the market's at highs and things are ebullient, like in mid-February. There was euphoria. People were buying these high beta growth stocks, speculative stocks. They didn't want to buy the defensives. Now those stocks have been crushed, and everyone's talking about defensive stocks. So I think what you really want to stay with is kind of financials, because financials work as long as you don't have a recession, and I don't think we're going to have a recession. I think consumer is telling you we are strong. We are not going to, the time and time again, I hear people talk about the U.S. consumer is going to weaken. The greatest, positioning over the last 10 years, never, ever bet against the U.S. consumer. So I think assuming this is going to kill the consumer is dangerous. So we like consumer discretionary. And then we're underweight in our positioning the defensive stocks. We have some insurance stocks have done very well, but I would be very careful now about making big allocation shifts. And that's not only sectorally in the U.S., but regionally around the world. You just don't know. And I don't think anyone really knows unless you are, right there in the Oval Office. And I don't think most people are. So I think it's very dangerous to make broad sweeping conclusions, other than the fact that I know that when you get down to these levels, now we've rallied up off this, so I'm not sure now's the time, but if we have a retest of that low, I think, it's a time to allocate a little bit more to equities.
So it is possible to retest that low, Andrew. Your comments are generating a lot of interest among our viewers. We have a viewer question for you right now. Do you think Trump reverses or just backs off until markets calm down?
I don't think he will back off unless the market calms down. So I think the rally he elicited makes him, digs in his heels, say, okay, he can be tough. But if we go back and retest those lows and you start to see credit have a problem, I think he'll back off again. So I think the bond market is in some ways controlling the narrative. I don't think the president would like to hear that, but I think it is. And I think the more the market rallies, the more cautious I get that he will be tougher. And the more the market weakens, the more I think there's a chance of backing off. So again, I don't know if it's there's V bottoms where the market bottoms and takes off. There's, retests of the lows, and I can tell you each year that we've had both. I don't know. I don't think anyone knows. And so, I think you should expect that we could go back and retest the lows of last week. I think it's very possible. But I still go back to this point, I think he sent a powerful message, which is, I want tariffs. I want, level playing for the U.S. or whatever he says, but I don't want a recession. And that's an important metric as you think about levels on the market, because, like I said before, when the market drops down more than 20%, it's happened 12 times, and 9 of them have led to recession. So that's the key number, 4,900 on the S&P.
So Trump has drawn the line in the sand. Andrew, what do you do with China? How does China fit into that global portfolio?
I like it. I like it for our global strategies, because I think in many ways, the more President Trump builds the barriers between U.S. technology stocks and China, it means the Chinese government has to embrace their large cap tech stocks. And so I think that is good for the domestic Chinese tech stocks, the big names that we all know. I think that's good. Now, having said that, you can't underestimate that there are regular barbs going back and forth in tariffs, and that's going to cause, volatility on a day-to-day basis. But in many ways, I would argue that what's going on is actually good for these large cap tech stocks. And that's why I think you saw some of the leaders, meet with the Chinese party for the first time in mid-February.
There's so much expectation of stimulus, big bang stimulus, in fact. What are you anticipating from the upcoming Politburo meeting in China?
Oh, you should ask a politician expert. That's out of my field. Other than I do think, I think it's interesting to see some of the low domestic retailers have reported in China have reported pretty good numbers. And so I do think there is stimulus on the way to support the economy. So I think there are, stocks are cheaper there. And I think there is stimulus on the way, and it's just an overall embrace of the economy, much more than we've seen, 4 years ago. So to me, that's intriguing, but within a context of a global economy, it's all about controlling risk. And I still see these, the political warfare that we're seeing as a danger overall.
Andrew, such a pleasure to have you on the show. Please come back again. Andrew Slimmon, Morgan Stanley Investment Management. Now, still to come, Xbank's founder and CEO says the EV maker is ramping up global expansion despite risks from the escalating trade war. Our exclusive conversation a little later on Insight. Keep it here with us. This is Bloomberg. Let's do a check on Korean assets on the back of the BOK, leaving rates unchanged, citing a big rise in downside risk, also a rise in inflation. We have the BOK Governor Rhee saying that the market will see high chance of rate cuts in May. Of course, he did talk about how all members agreed to rate cuts in the next 3 months. The Kospi currently up by 0.7%. We have the Korean won trading at 16-month lows, currently at 14.17. It is down 0.1% versus the USD. Well, still to come on Insight. Aberdeen Investments will be joining us to talk about market risks and the outlook on China, as well as President Xi Jinping continues his trade mission in Southeast Asia. Details on that. Keep it here with us. This is Bloomberg.
I guess what's happening is that people using gold, right? So everyone's rushing out to buy more gold.
Look at gold as well. I think that's quite interesting what we've been seeing there. Quite some move, and I think people diversify currencies even more. So we are still bullish on the gold side, even after we had quite a run.
I think physical gold is a better holding because gold equity itself represents quite a significant amount of risk.
It's not the ideal hedge all the time, but I think gold has done quite nicely in this environment. We do expect some further gains on this one because because I think if you look, as I said, on diversifying currencies, that's also something people really take into account.
Insights from our guests this week on the surge in gold prices. It's done more than just nicely. It's been a stunning rally this year, up some 28% already to outpace all of its gains in 2024. Growing fears of a global trade, geopolitical uncertainty, and a possible U.S. recession pushing investors into haven plays. Now, what's not a haven play is perhaps China, but it has reversed its losses this morning, currently flat as we speak right now. It is at 37.78. Investors, of course, marveling about the trade war that's escalating. And, of course, Chinese President Xi Jinping has wrapped up his visit to Malaysia. We'll have details just shortly later. CSI 300 index currently flat, as we said, the Hang Seng in positive territory. Now, when it comes to that visit of Xi Jinping to Malaysia, in a joint statement, the two countries did say they'll expand economic cooperation and work on a stable industrial supply chain. President Xi is heading to Cambodia next, continuing his push to rally Southeast Asian support in the trade war. Our very own Avril Hong joins us live from Kuala Lumpur. Avril, what did Xi accomplish in Malaysia?
Yeah, Has, I think Xi has accomplished quite a lot in the Southeast Asian nation. I mean, you just talked about this joint statement between the two sides. They are pledging to expand economic cooperation, bolster supply chains, but it's also gone as far as to some commitments towards setting up mechanisms for joint security, defense, foreign dialogues, things in that direction. And given the context, right, that this is coming at a time with China's trade war with the U.S. and how the Chinese president has really been trying to rally these Southeast Asian countries, telling them to resist geopolitical confrontation. Those were his words, as well as promoting the idea of an Asian family. Then think about as well how warmly he's been received this week by the Malaysian Prime Minister Anwar Ibrahim, who went as far as to kind of talk up China, heaping praise on Xi Jinping, saying that the world at this moment kind of needs steadiness, reliability, and that these are qualities that China possesses. And that's despite some analysts already flagging that for Southeast Asian countries, they have to be friendly to Beijing, but not too friendly so as not to antagonize Trump. So given how warmly received Xi has been by Malaysia, I'd say it's been pretty successful, this visit for him.
It all depends on the kind of investments they agree on as well. Avril, in terms of Xi Jinping's visit, he's heading to Cambodia next. What else can we expect?
Yeah, I think we can expect him to continue turning on the charm. I mean, Has, you think about the significance of these visits. It's really something we haven't seen in terms of a state visit from the Chinese president to Malaysia or Cambodia in more than a decade. So it really tells you the kind of climate we're in at the moment. And we're hearing from the Chinese president, or the Chinese side at least, they're kind of talking up these Chinese investments in Cambodia, to your point about investments, right? And this is related, of course, to the Belt and Road Initiative, which is a marquee project of the Chinese president, but that has been slowing in many parts of the region in the past couple of years. Keep in mind, amid all this, that Cambodia is one of, if not the strongest ally for China in this part of the world, and it's been hit really hard by Trump's tariff threats in terms of the rates of levies, the highest in the region, as Trump seeks to curtail the China Plus One strategy. So I think overall what we can expect as President Xi wraps up his three-nation Southeast Asia tour is for him to continue intensifying efforts to pull countries in the region further into China's orbit. Has?
Avril Hong, thank you so much for that. Let's get back to market action and bring in Pruksa Iamthongthong, Deputy Head of APAC Equities at Aberdeen Investments. Good to have you with us. All gloves are off. It does seem like there's an escalation in trade war. What are you anticipating? Some say that if we don't see de-escalation, we're going to see a global recession.
I do think that the risk of recession is certainly rising, especially if we don't see a de-escalation. So I think in the next 90 days, it is a crucial period to watch as to whether these 90 days will be the the 10% baseline that we have seen for many countries would be the real baseline, or there will be some sort of negotiations, and we will just have to watch where the tariff amount ends for these countries. And of course, the big elephant in the room is still where does the tariff rates for US and China ultimately ends, whether the more than 100% tariff rate that we see today is the baseline or it actually escalates further. So I think the picture is still very much uncertain, and depending on how this develops, there is a risk of global recession.
What assumptions are you making, or is it too soon to be making assumptions? Have you made changes to your strategy, to your portfolio?
What we have done leading to the Liberation Day is to keep cash a bit higher, just so that...
Is it what, 20%, 30%?
No, our mandate doesn't allow that, so it's probably be closer to about the 5% type of level versus, say, the usual 1 to 2% type of level. But what that means is that it allows us to be able to buy the dip on the quality stocks that we like. So that's the first thing that we do. Secondly is to really up the quality of the portfolio, look for the relative winners, and it's hard to find at this moment given all the moving pieces, but I think really stick with the high quality names, those that have the technological advantage, whether you think about the tech sector that has been at the forefront of the whether semiconductor side of tariff as well. Those that are with the technological advantage, high bargaining power, would be in best place to pass the cost on, whatever cost it may be. And then you will have to think about how this cost gets shared across the supply chain, but also what it means for demand destruction. So there's quite a lot of moving pieces. So I would say that not doing very much and just watch how it goes. If there is a stock price opportunity, we should be buying the dip for the quality companies.
In terms of risk appetite, how much is there among your clients?
I would say there's a lot of inquiries, certainly given the way that the market has been moving. Even for Chinese equities, we are seeing lots of inquiries coming through for APAC equities. And I think the inquiries have gone quite high because of the concern about the end of US exceptionalism as well. So people are thinking about switching money from the US side to emerging market equities that should start to benefit as well from a weaker dollar. Many countries in emerging markets are also able to, because of this and inflationary pressure, able to start to cut rates to help to boost the economy. So there's quite a few mitigating factors, but I think no one is really putting the money to work just yet, given where the uncertainty is at the moment.
Is China looking more attractive than the US at this point in time? Valuations are low. They're looking really attractive. The expectations of further stimulus. And if you take a longer-term perspective, China might just have its house in order.
We do think China is starting to get its house in order after, I think, 3 years of house cleaning, if you like, whether you think about house cleaning in the property sector, trying to increase their self-reliance because of increasing trade restrictions as well. And China is sorting its way out in that. Where we are right now, we do think that the geopolitical risk and tension is high, external risk is high. So on a relative basis, what's more interesting in China right now is actually the domestic A-share market that is very much dominated by domestic retail investors as well, less susceptible to foreign fund flows. And if you look at the stock composite within the domestic A-share market, it's also very much catered to consumption and stimulus. We do expect that the result of all these external pressures, we are likely to see China stepping up on their stimulus. Could be as soon as the end April, Politburo, and that should be at least a short-term boost for the stimulus. But again, it depends on where the tariff ends and how this will pan out in the future.
Realistically, as we sit here right now, what kind of returns do you think we can get from Chinese investments?
We do think that if you look at the earnings growth, when we look at the earnings growth, in heading into this, prior to the tariff announcement, we were looking at about mid-teens type of earnings growth into China. Now, obviously, that has to come down given where things are. But I would say that when you look at domestic-oriented companies, earnings growth have actually start to stabilize, and we're starting to see that tick up in earnings revision. So I would say about 10% type of earnings growth, and if you think that represents fundamentals and the way that the market will react to that, that should represent the return of the market.
We talk about a weaker dollar environment. We're also looking at a weaker oil environment that makes actually India very attractive, which has gone through quite a correction, making Indian stocks attractive. Is that a fair assumption?
Yes, that's right. And I think India has always been a place that we quite like from a bottom-up perspective, structural long-term growth perspective. But the issue of India has always been expensive, right? It has been an expensive valuation. And I think from the end of last year to very much the first quarter of this year, we have seen quite a deep correction in India. We think a lot of this is cyclically driven. And where India is right now, whether you look at the relative, we talk about relative weakness from the tariff impact, even Asia is actually India that are able to have a bit more flexibility to navigate through these challenges. You look at the pressure on the currency as well as on oil and the rates in the US as well. This allow Indian central bank to cut rates, which we have done, which have seen them doing as well. So that should be supportive for the growth of Indian economy. So I think right now India does look attractive, and it's one area that we have been adding to within the Asia portfolio.
The thing is, it is supported by the retail investors, but therein lies the risk as well. If there is a massive slump in terms of sentiment, that might just be the weakness in the Indian market as well. I mean, how are you assessing the risk of retail investors propping up the market?
We have seen, I think, over the last 1 to 1.5 years, foreigners exiting India, retail investors have been opening new accounts and really propping up the market. Now that trend, we have seen over the last few months, retail investors start to sell, and foreigners are selling, but now foreigners are also starting to come back in a small way. So I think the key that you talk about with retail investors is something to watch. So we are watching the stock market, obviously, because that is a leading indicator. We are watching the pace of account openings of the retail investors. We are watching the launch of mutual funds as well. So these are the few leading indicators that we look out for to sort of understand where the risks of retail investors lie, because that has been supportive of the fund flow so far into the domestic market in India.
Hang tight. Pruksa Iamthongthong of Aberdeen Investment is sticking around as we take a look at the chip sector later. Now, with the world's largest contract chipmaker due to report today, even as it faces headwinds from President Trump's shifting trade policy, we have more on TSMC's earnings outlook next. Keep it here with us. This is Bloomberg. Welcome back. The top global maker of chip manufacturing technology reported first quarter orders that fell short of expectations, warning that it doesn't know how to quantify the impact of tariffs on the industry. ASML's shares tumbled in the Netherlands and are down almost 40% over the past year. CEO Christophe Foucault says recent tariff announcements have increased uncertainty and the situation will remain dynamic for a while. Now, ASML's warnings comes as one of its top customers, TSMC, gets set to report its latest earnings in the coming hours. As this chart shows, analysts are growing a bit more skeptical of the Taiwanese company's outlook, with 2 analysts dropping their buy or outperform calls this month. For more, let's bring in our Asia equities reporter, Charlotte Yang. Charlotte, what are analysts watching for when it comes to TSMC?
Yeah, so we already know is that TSMC has reported 42% for the first quarter sales. That's stronger than expectation. But what really analysts and investors are watching is whether this leading global chip maker will make any change to its full-year sales guidance. So earlier, the company has guided that it expects sales to grow this year by mid-20% in US dollar terms. And now JP Morgan, which has a buy rating on the stock, now they actually expect that the company might lower its full-year sales target a little bit. And also Deutsche Bank even expects that there is that possibility that the company might just pull its full-year sales target altogether. So, and also, TSMC has been really, global investors' favorite because of its technology leadership and how reliable it is. But this season, people are watching what it will say to in terms of tariff impact, as well as joint ventures with Intel. That are the key things investors are watching.
Charlotte, you can only imagine that because of the uncertainty, the guidance, the comments from TSMC will have huge impact, not just on the company, but also in tech stocks in Taiwan and elsewhere.
Yes, exactly. So it not only mattered to TSMC shares, but also Taiwan, given, TSMC, it is the top weighted member on the TAIEX index, which makes up more about, I think, around over 1/3. And also how, the guidance will have this provide signals for investors to assess, its all the supply chains on the semiconductor. And especially after ASML's earnings result disappointed yesterday, and then we saw the huge sell-off, the big sell-off in the Philadelphia Semiconductor Index. So TSMC's results, which we'll see in a couple of hours, are really the key to watch.
Charlotte, thank you so much for that. Bloomberg's Asia equities reporter Charlotte Yang. Now, Aberdeen's Pruksa Iamthongthong is still with us. What are you making of the anticipation in TSMC's numbers? I mean, it was a beat in the first 3 months. People are looking for the whole year, but it's hard to give guidance amid this environment.
Indeed. So I think right now the 3 months is in the bag, but what's more important right now is actually the forward-looking statements from TSMC amidst this volatility. So I think currently, given the volatility and the uncertainty, the biggest uncertainty right now is, we talked about the tariff impact earlier and what it actually ultimately means for end demand weakness. I think that's the uncertainty whether TSMC will need to guide down its full-year outlook today, or will it wait another quarter when things are a bit clearer to start guiding down? So I would say it is reasonable that we start to see some weakness in terms of the full-year guidance, but how much and ultimately where it lands will depend on the outcome of the tariff and, again, demand weakness.
Is it possible that TSMC drops its guidance altogether for the year?
It is not really within, usually TSMC is very methodological, so it is quite unexpected to see that, but we are in an unexpected, situation as well. So I do think that it is possible, but I do think it's unlikely that we will see a drop in guidance today.
How attractive is TSMC trading right now? 14 times earnings. That's lower than its average for the last 3 years, which is 16 times earnings. Would you be a buyer?
I think we will be a buyer at perhaps a later stage or when the share price comes down a bit further, simply because I think we talk about, number one, how there will be relative winners within all this, sticking with the top technological leaders, quality companies. TSMC fit all that boxes. So if there is a big correction, it is a good time for long-term investors to accumulate, because from a business model perspective, TSMC will turn out relatively better than the rest of the supply chain. But I think the uncertainty is quite high right now, and there are many moving pieces. I do think that it is also quite hard to analyze the impact of tariff when you don't know what the tariff number is at the moment. So I think with moving pieces, we will want to wait and watch for a while, but it is something that we are eyeing for the long term.
As we said, TSMC is a bellwether for the tech industry. So is NVIDIA. And we've just seen new and more restrictive tariffs on the company. How are you assessing what the impact might be from that?
Yes, I think the way that we look at it is that it is an ongoing development since last 1.5 years, where China has been undergoing export restrictions, and this has been on a tightening path, if you like, whether it's in the Biden administration or with the Trump administration. So we do think that the latest H20 ban is in line with what we are seeing in terms of the tightening pace of the development of export restrictions. So that's what we are watching. Prior to DeepSeek, we were concerned that this perhaps might threaten the long-term sustainability of AI development within China. But I think what DeepSeek has demonstrated is that China has the ability to optimize its way out, but also to innovate its way out over the long term. So that means that as we move into the application phase of AI development in China this year, driven by the large internet companies, that should continue to go on, and that can be done through optimization of the systems and chips and the model that you use. So that pace hasn't really slowed, and this is something that we do think will continue to be the driver for some of this Chinese development over the long term.
Do you see NVIDIA underperforming in the coming months, and do the Chinese tech players and chip-related companies being more attractive as an alternative?
I don't cover NVIDIA myself. We are Asian side of things, but I think right now where you do think that there is quite a fair bit of uncertainty is those that are linked to the 2026 capex spending by global infrastructure guys. Whether you look at the likes of Microsoft, for example, 2025 is in the bag, and I think that spending will continue. 2026, given where the environment is at the moment and the uncertainty, it is reasonable to see whether there will be a pause in terms of spending, or they might want to rethink about how they spend because of the innovation and development brought about by DeepSeek and optimization of supply chain. So there is an air pocket that I think we will need to watch as we head further into the year. And as a result of that, that creates a bit more uncertainty for the tech supply chain on that front. On the other hand, we talked about the Chinese large internet companies or those on the application front continuing to proceed. They are able to do with the current chip supply that they have. So we do think that phase will continue and is domestically oriented within China.
Pruksa, thank you so much for your insights today. Pruksa, Iamthongthong of Aberdeen Investments. Now, we're also following the latest on how the trade war is hitting automakers. Chinese EV maker XPeng says it's still optimistic about its overseas ambitions despite a worsening trade war between Washington and Beijing and the EU's separate tariffs on Chinese cars. XPeng hosted its first global launch with the new X9 minivan in Hong Kong this week as the automaker announced growth plans from Indonesia to Germany. Founder and CEO He Xiaopeng told us exclusively that XPeng's international expansion will depend on stability.
For a company, we expect stability. In any case, stability will bring political, economic, and cultural certainty. And only then we can formulate a clear corporate strategy.
Ford, meantime, is preparing to raise prices on cars starting next month if President Trump doesn't deliver on the tariff relief he's hinted at for automakers. A memo to dealers said the increase will affect Ford vehicles built in May, arriving in U.S. showrooms from late June. It's a clearer sign yet that automakers are likely to pass on at least some of the higher costs brought on by Trump's 25% tariffs on imported cars. And we're counting down to the ECB's rate decision later today. Bloomberg Economics thinks a 25 basis point cut is on the way due to the impact of U.S. tariffs on the Eurozone. Watch Bloomberg's coverage of the policy decision and President Christine Lagarde's news conference live at these times on your screen. And that is it for Insight. We're taking you to Phnom Penh through live pictures as Cambodia awaits the arrival of Xi Jinping. Of course, we have President Xi promoting the idea of an Asian family and called for regional unity during a tour of Southeast Asia in an apparent effort to counter U.S. pressure on nations to limit trade ties with Beijing. Of course, he's headed to Cambodia from Kuala Lumpur. This has been Insight. Keep it here with us. This is Bloomberg.